Right. So, good afternoon, all of you. It's a matter of great pleasure discussing with fellow academics, students, and corporate executives regarding risk management, particularly with reference to financial derivatives. The concept of risk has been known for a very long time in finance, but at the same time, it was actually made into more meaningful interpretation only, one would say, about 30 to 40 years back. Everybody realized that risk related to uncertainty. Everybody realized that risk is not a good word and that risk needs to be managed. But what has happened over the last 30 years is there have been very, very important attempts, not only in finance, but also in other areas of management, by which risk is sought to be measured. And once it is measured, the next aspect of risk is how it can be anticipated. And once you try to anticipate risk, then how you manage it. So, to cut a long story short, risk actually would mean any sort of uncertainty, in which if one has a plan for the future and one is absolutely sure that the plan is going to fructify, then there is no risk at all. But that seldom happens in real life. In real life, we have so many plans, but the plans can all have fluctuations. And these fluctuations can be to our advantage sometimes. Sometimes it can be to our disadvantage. So basically, while the word risk is used for uncertainties that are disadvantage, basically the measurement involves both the favorable as well as the unfavorable condition. In other words, what it does is the measurement of risk would involve how much of fluctuation happens from the expected level. That is actually the level of risk. Of course, we are only bothered about the adverse risk. The favorable risk is a bonanza, which we would anyway welcome. So, risk and risk management always seems to be a very interesting topic as far as management is concerned, corporate executives are concerned, CEOs are concerned. But over the last 25 years or so, we have had the advent of financial derivatives. Financial derivatives have been there for hundreds of years. They have been there in unstructured form, and many of us have been using financial derivatives in one way or the other. But in a structured form, in terms of markets, in terms of greater understanding and wider acceptance, we have had all that happen in the last 25 years or so, in the sense that these became traded, more literature came about, common man began to take interest in this and also trade in these wonderful instruments. So financial derivatives are considered as the most important tool in the hands of the finance manager for risk management, because it enables so much of flexibility, it is cost effective, and it can be fashioned in whatever way one likes. So that is actually the long and short of what financial derivatives can do. Now, there are some people who won't even listen to a discussion on financial derivatives because they either quote rogue traders, people who have used derivatives for wrong purposes, or they quote the 2008 crisis, finance crisis, which many people attribute to the wrong usage of derivative instruments or wrong usage of derivative attributes, one would say. Be that as it may, we are not going into that argument, whether people would accept it or not. The idea is that if one understands derivatives, one is able to do more things than what one would have been able to do without derivatives. In fact, the study of derivatives will tell you that, what we have been missing, what we could have easily done with risk management, with value enhancement, which we could not previously do, has been made possible with financial derivatives. Consequently, there are some wonderful authors like Richard Kolb and others who have said that there is a derivatives way of thinking. That is, in management, you can always think in terms of derivatives, think in terms of options, think in terms of alternatives, think in terms of paying a price for a choice. And all these have come about because derivatives have first been understood, and then that has been translated into a way of management. From uncertainty, one comes to expected values. So statistically, we know that if there are some probabilities of various occurrences, the expected value will be each occurrence into the probability and the weighted average of that. The uncertainty would be the standard deviation, which will happen from the certainty level. How much of deviation will take place from the, the expected levels. These are projected by companies when they go into projects. For example, let us take the case of a very recent occurrence when somebody has bid for the 9th and the 10th franchise for IPL. And when they do that, how much can they bid for? What is the value of that particular franchise? How much can I pay for it and yet get a net present value? So the projections will actually go into several years, the years of the horizon, what expected revenues can come, what will happen if the franchise doesn't win the trophy, what happens if it does not win the trophy, what are the advertisement revenues, what are the stadium revenues, what is the shared revenue from the Board of Control for Cricket in India, as well as all the known areas of income and expenditure. But that will be more like saying that it's at expected level. And there are going to be uncertainties. There are going to be years in which, like, for example, the previous year, it was disrupted when we had the pandemic, or it could be some other things which are not good. But it also could be wonderful because maybe in the years to come, as some of the cricket pundits are predicting, many of the top players will actually be interested only in playing in T20 franchises, and they will not be playing in regular cricket, which means actually it's a greater thing. It will become a great event in the country. So we don't know what sort of uncertainty is going to happen. So these need to be projected. And based on the projection, there should be an action plan. The action plan is you're going to look for signals. You're going to look for events. We're going to look for signals as to where the uncertainty, which direction the uncertainty is going to take, and being, after getting the signal, what is going to take an action. So it's, in other words, being ready. The concept of risk is actually being ready. So there are some extreme views about risk. There are people who believe that risk can be assessed, people who believe that risk can be estimated and nothing is totally uncertain. It can be all put down to discrete uncertainties. Some people say that even if it's a continuous uncertainty, it's not going to be so much off the mark. Very few people in that school of thought would believe that uncertainty is so total that it cannot be predicted. However, then we have wonderful authors by, Talib's book on Fooled by Randomness, Black Swan, are also about risk. And they give us examples or postulates about how the calculations about risk can be totally misleading. They will just not be good enough for us. So because of all this, we have several viewpoints on the whole thing. And these viewpoints are as diverse as management itself. So there cannot be unanimity. And our aim is not to bring about unanimity. Our aim is not to say or win over people and say risk management is possible and derivatives are the greatest instruments for risk management. No, we are not interested in doing that at all. What we are going to be more interested in doing is that we're going to see the exciting aspects of financial derivatives and how these financial derivatives can actually aid in risk management in conditions which are predictable, in conditions where these are suitable. We are not saying across all conditions, nor are we claiming that this will be devoid of risk, nor are we claiming that this is a foolproof method. So it is that principle that one has to understand when one studies derivatives. Basically, when you look at classic literature on strategy, classic literature on how risk can be avoided, there are three basic methods that people advocate for risk management. The first is diversification. Many of us would be familiar with the capital assets pricing model, which actually tries to do a balance between risk and return. Risk return is the balance that actually takes place. And in risk return, what happens is everybody is striving for greater return at the same level of risk or by reducing the risk, or a lower risk for the same return or a greater return. So this striving by everybody gives rise to what the capitalist pricing model says a theoretically possible optimum curve, and based upon that people will be in various horizons in that. The other story that capitalist pricing model has been able to establish beautifully is that diversification is the most important way in which risk can be managed. What it seeks is that when you have multiple holdings of various different assets, preferably with lower correlation among themselves, then the risk level is reduced. Of course, diversification has no meaning at all if the assets that you are using for diversification are heavily correlated. They should be uncorrelated. So the fortune of one should actually be the disaster of the other, and the disaster of the other should be the fortune of the one in the most ideal case. But that sort of ideal case cannot be achieved. So we're going to have some sort of a diversification, which actually means the overall risk can be reduced and the return can be increased. So this is called optimization of the portfolio, which is actually the hallmark of portfolio management theory. So that is one way of managing risk. So if a company is doing very well in its own business and is growing, it can suddenly think, okay, what can go wrong? The industry with which I am working may not quite work in the future, in the sense that there could be competition from a different industry altogether, or the technology could change. So if I got surplus funds, could as well diversify into another unrelated area. If I am diversing into the related area, it doesn't have any meaning at all, because it is again the same thing. The fortune of this will affect the other one as well, or the misfortune of this will affect the other one. But if it's a different area, it will not affect. So one can go into diversification. The second aspect would be going into a hedging. Hedging would be assessing what is the risk involved and getting yourself reimbursed if the risk event takes place. So we got instruments which are, you can have the benefits as well without having to have the downfalls, which is options. You can have the benefits as well as the downfalls, which is the flat curve, which is called futures, and other instruments which can be made hybrid with futures and options in such a way that you can have the hedging balance that you require. And hedging is a practice that every company has to do. So if there is an uncertainty regarding the price of a raw material which I have to buy, I need to hedge it by having a long-term contract with a supplier for a specific price. Either I say that I am also obliged to pay the price and you are also obliged to deliver at the price, in which case it is a futures contract. Otherwise, I can say you are obliged to give me at that price, provided the price goes up. But otherwise, if the price is coming down, then I will have the alternative of buying it from the market or buying it from you at a lower price. That will be an option. So it depends on the bargaining power. It also depends on the market structure, whether you are going to do a futures transaction or an options transaction, but both are hedging. Hedging is the risk has been identified, quantified, and it has been more or less nullified for its downward effect. In the process, you will either have a straight line, in which case you are freezing the price, which futures would do. Otherwise, you have the best of both worlds, as options would do, but paying a price for that, which is the premium. The third would be not going to a specific hedge at all, but take an insurance policy, which will be a small payment relative to the asset's value. And if the risk does take place, the insurance stands for you. If the risk does not take place, the insurance has just been paid by you. So it is relatively small, but it always helps in case the worst happens. In a way, insurance is also a way of hedging. But these are the three classic ways in which you can actually manage risk. Today also the scenario is the same. Even after the advent of derivatives in its full form, the three facets mentioned there are the same. However, derivatives give us more flexibility. They give us more flexibility as to the combination of instruments that we are going to use. as well as the combination of effectiveness that we are going to have, including the tenure, and sometimes derivatives can be carried over for longer periods. So these are advanced strategies that one has in derivatives, which actually changes that a little bit, but basic principles remain exactly the same. So basic applications of derivatives would be in quick risk management. Suppose I am going to sell a commodity. My only anxiety is that the prices of that commodity is going to come down, might come down, might go up as well, but I am quite happy at a particular level of price. And so I'm able to find a buyer from me who will buy from me a specific quantity at that pre-agreed price, which means that regardless of the price movement after that, I'm going to get that price at the end. So that is one basic application. The opposite of that, or the other side of that, would be when I want to buy, a raw material, I want to freeze the prices. I enter into an agreement with my supplier saying that regardless of the market price at that point of time, you have to keep giving me, keep supplying me raw material, the specific raw material at a particular price. So this is the basic application. The basic application is another small change. It can be one to one. It can be by two individuals across the table, which is called OTC, over the counter. Otherwise, it can be structured through a market. When it is structured through a market, what happens is we have got a structured stock exchange or a commodity exchange, which actually regulates and also monitors the trades and also stands guarantee for the trade. What is more, when such a things happen, we don't really have to have two individuals. It can be one against the world against one, in the sense that I don't have to know the buyer does not have to know the seller. All the prices are being quoted on the screen, it's online available, so the transparency and visibility is much higher. That is a flexibility to the application. The basic application is still the same. It can either be a futures contract or an options contract, but then you are changing the application's mode by having it structured this way. And then there could be, you could create your own combinations. You could also create your own tenures. And by doing that, you add a little bit more to the risk management. The aim of a risk management strategy also is not to pay too much for managing risk, not to incur too much expenditure for managing a risk. Ideally, we don't have to spend anything at all, but that will not happen. There'll be no free lunch in derivatives. So one has to pay something, but optimize that with a lot of combinations. What has happened is when derivatives become used widely, when the volume picks up as far as derivatives are concerned, then it becomes a very, very effective instrument because the price discovery is ideal. The price becomes theoretically correct, at least. And when it's theoretically correct, more trade can again happen. So it can trigger more trade. This is actually the advantage of wider use. And wider use also will give rise to other possibilities of derivatives, of clubbing the derivatives together, or having a tenure based adjustments to derivatives and doing other advanced tradings that are possible. But as far as corporate houses are concerned or companies are concerned, they take a total approach. The total approach would involve two things differently. One is they decide what is the total exposure that they have. And based on the total exposure, for each individual exposure, what instrument do I use as a matter of policy? If the exposure goes beyond a particular limit, say 10 lakhs, then I would use type A derivative. If it is more between over 15 lakhs, I will use something else, etc. You club it out, and you also make sure how much of your exposure you are going to cover. Because in a market, actually, suppose I'm a seller of something, and the market prices are fluctuating. I am very happy to get 30 rupees as the price per unit. The market prices are fluctuating. So I am tempted to hedge. I hedge by asking a buyer to actually commit to buying from me at 30 rupees. And if the price really goes up after that, I don't get the benefit of the higher price because I've frozen everything. So companies sometimes follow the approach of saying that, okay, 75% of my exposure I will hedge, 25% I will leave it open. And when you leave it open for the 25%, it can either be a bonanza, prices going up, or a disaster when the prices come down, but it's only 25%. 75% is made stagnant. So, like that, companies can have policies. So, what does one do to understand this? Every annual report, Infosys, TCS, all the big companies, they will have in their annual report a risk management practice page in which they lay down their broad policy of risk management. And that is how they have a system of risk management for themselves. And that gives us an idea about what the company is actually doing. It doesn't mean that that's the best. There's nothing called the best. What turns out to be best will be depending upon what the markets will ultimately say. So we have no idea about that. But having said this, all this requires some skills, some understanding of the concepts, and some practice as well. So there are risks involved in derivatives. In the hands of an inexperienced trader, in the hands of an inexperienced person, or a person who doesn't know enough about derivatives, we're going to have more risks added to the existing risks. And there will be pitfalls in that as well. However, with greater surveillance, with a greater committee sort of working and greater experience, people can really value add to their companies. I mentioned earlier about what is called the derivatives approach to management. The derivatives approach to management is basically something that you think of any situation as giving you a choice, as something that you can hedge, something that you can prevent. So, for example, when one goes and buys a flat, so you're immediately thinking, the derivatives way of thinking is, why do you want to commit straight away? Can I take more time? How much time do I have to commit? And what price do I pay to have the commitment for a longer period? Now, keeping the option, keeping the derivative with you for a longer period enables you to have the right and gives you more of power. So, like this, in every situation, a derivatives way of thinking is possible. So, people have gone to the extent of valuing land, valuing properties, etc., in various ways which are connected to derivatives, but not directly connected to derivatives. There are several concepts which have come as part of derivatives. Real options are one important thing. Real options. So, for example, when you wonder why Tatas are paying such an exorbitant price for taking over Air India, it is a part of real options. Real options would mean it is a right without an obligation for something else. I mean, in this case, they are paying actually such a lot of money. It will not quite be real options. But if you thought of some of the other takeovers which have taken place, smaller takeovers which have happened, you will think that it is a small price paid for a bigger thing based on the uncertainty. If the uncertainty is favorable to you, you exercise the option. You actually use the option for higher things. Otherwise, you discard. And international cross-currency management is another great application that has happened because many companies now have multinational operations in various countries. And then you need to have a coverage, a cross-currency management coverage. So which can be that you hedge one currency against the other, or you net the currencies together, you use swap instruments. You also have other instruments which are like euro dollars, futures, etc., to manage your cross currency. And it all depends again on your estimation of how the currency rates are going to behave and whether you're going to need a real coverage for that. Also, it depends upon how these things are translated back to your original currency in your accounting statements. Structured products which were a disaster in 2008 are once again coming up in many ways. They have got an exciting possibility. In 2008, the surveillance was not good enough and the knowledge about these were not good enough in my opinion. But now at this point of time, we have greater knowledge, more people have understood this, and structured products have a greater advantage. They are actually a bundling instrument by which anybody's portfolio, which is a bundle, a bank's portfolio of housing loans, for example, can be created into bundle and separated synthetically as those which will be definitely repaid, those which have doubts about repayment, and those in the middle. And based upon that, different rates of interest can be offered for bonds to be issued against this. So all exciting possibilities people have created. Only thing is when it comes to the second or third stage, it becomes a little complicated. Valuation becomes too mathematical. That's actually the problem. So that's where people are a little put off. We don't want that sort of mathematics because one can never rely on those sort of figures. So that becomes a little bit of a problem. So one has to stop at some point in time. Don't make it too complicated. That's the most important aspect. There are some exotic instruments in the sense that basic derivative instruments can be twisted. If you and me enter into a contract, we can say it is a basic derivative instrument, but we are going to change the terms and conditions in such a way, the way we like. So there are several standard exotics, standard OTC contracts, which can be customized to our requirement. So this can be done. It is being done by many people. That's why we see all sorts of complicated things happen. But once it becomes more complicated, that is where all the issues come and all the criticism starts against derivatives. So I would like to conclude with two small things. One is the framework for risk management is entirely a thinking process. It has to use the concepts, of course. It has to use all the principles from finance in various ways. But it also has to understand that we are still playing with instruments. We are still playing with uncertainty. One of the classic books in corporate finance is one by Braley and Mayers. And Braley Mayers, you have one wonderful statement, what we do not know about finance. And they very clearly say that we do not know how the markets behave. We do not know how the stock markets behave. We don't know what the prices are going to be tomorrow. We don't know how the foreign exchange rates behave. We don't know how the interest rates behave. So there are several things that we don't know. So we have to understand that we are playing in a realm of uncertainty. And even if we are successful, sometimes it doesn't mean that we have been smart. It is that we have used our experience, we have used the instruments in such a way of an optimization, but we have to be humble enough in understanding that sometimes these things can fail as well. So you have to limit your failures to a limited extent. It has to be in competent hands. It cannot be in the hands of the novice. It has to be done only with people, by people who understand these instruments very correctly. And whatever, even they need to frequently review their performance and see how they are doing. And the whole thing needs to be reported. Reporting is a very peculiar thing. Many people are put off with this small statement saying that many of the things in derivatives are off balance sheet. Meaning some of the derivative transactions don't appear directly in the balance sheet at all. They are only part of the statements. And many people will stop with looking at the profit and loss account and balance sheet. They don't look at the detailed statements or the detailed explanations that come along with the annual report. But that's true. Derivatives are not the fundamental. They are actually going in behind. So the reporting needs to be also better, or the internal reporting system within the company also needs to be better before one embarks upon all that. This is the framework. The one aspect I want to say. The second aspect I want to say is, in doing all that, what I have tried to attempt in my book on derivatives and risk management is that, there are some classic books all over. Derivatives are a subject which is actually going into new dimensions. But what I have tried to do is, I have tried to rid it of all complications and all detailed mathematics and try to take a very simple step-by-step approach. In the process, I've tried to make it as short as possible, as crisp as possible, so that one has to have the basic understanding. My own theory is that once people understand the basics, and if they are really interested, they will always be able to develop the advanced things. But if you put all the advanced things into the basics also and make it into a crammed sort of literature, then it becomes very complicated for the person to understand. And that has been my philosophy with my students over the last 24 years when I've been teaching derivatives in many places. And it has been based on the students' feedback and based upon the students' inputs that the inspiration for the book came for the first time some years back, and it has continued after that. The encouraging response that the book has had gives me confidence that that approach is at least good for the basic purposes. I always hasten to add that basics are the important thing, but it doesn't claim to be an exhaustive book on derivatives. It only claims to be a basic book which actually gives you everything that you need, whatever we discussed right now, and all the other things that you need to supplement that can be taken forward by oneself. So that's what I want to say. That's thank you very much, and this is about the book. I'd be very happy to have your comments and feedback and questions, if any. Thank you very much. Apart from questions, you could also give me your thoughts on what you feel about derivatives. Yeah, Shital, explaining the hedging concept is a long process. It's going to take about a couple of hours. But just to give you a small example, you take yourself as a person who grows tomatoes, and tomatoes at this point of time, you're going to think that now it's October and you're going to harvest in December, 2 months now, and you're going to, let's say, harvest 100,000 kgs. It's a huge farm, and 100,000 kgs of tomatoes you're going to harvest. And the current price of tomatoes is 15 rupees per kg, let's say. And if it is 15 rupees per kg, you are looking at 15 rupees into 100,000 kgs. You are actually looking at 15 lakhs of rupees, which is something that is very agreeable at this point of time. And you think that there'll be a wonderful thing to happen. But you don't know what's going to happen from now up to December. So things can go terribly wrong. There will be rains, there will be things, and harvest, of course, will happen. But at the same time, the prices can fall and things can change. So if that is going to happen, the prices can come as low as 5 rupees per kg, which means instead of 15 lakhs, you're going to get only 5 lakhs. Or it could actually shoot up to about 25, which means you'll get 25 lakhs. So this is the risk horizon that you're facing. So if you're going to do a hedging, you could actually find out somebody who will buy tomatoes from you 2 months down the line, December, by a contract entered into today for 100,000 kgs at a price around 15 rupees. Now, if such a contract takes place, it is a forward contract. It also can be called a futures contract if it is through an exchange. And what you do is the 15 rupees is a sacrosanct figure now. Regardless of the price at the end of December, you will get your 15. And if the price is greater than 15, again you will get only 15. If the price is lower than 15, you will still get 15. Of course, subject to the other person not defaulting. So that's where futures come in. So I'm not going into that. So basically, you are having that structure there very beautifully. This is the basic hedge. This is what we are trying to do in that hedge. Dr. Jayakumar, there's too complicated a question for this session. There are so many techniques that we use for controlling uncertainty, but let us understand whatever we do, total uncertainty can never be avoided. Total uncertainty and the losses that can come out of that can never be fully averted. It is only what we can see, what we can plan, what we are able to see that can be done reasonably effectively. But it is beyond that, derivatives have limitations. They are not miracle instruments. Many of these things are mentioned in the book and with examples in the stock markets as well. And so that's how we have tried to do. So I'm going to the question answer panel right now. And okay, I'll take both the questions together. Yeah, the first question by Vasumati is that yes, derivative markets are affected by volatility of other markets. It's true because derivative markets are based on uncertainty. If there is no uncertainty, there is no derivatives market. The derivatives market derives its strength and its existence only by uncertainty. So it is the uncertainty in the other markets like petroleum prices, markets in general, or commodities prices, etc., which actually is what uh, brings us to volatility in the derivatives market. And volatility, oddly enough, is a good word in derivatives market because you like volatility. You like it because a derivative instrument actually smothers the complete uncertainty. So to that extent, you can say derivatives are they like volatility. So in a way, other markets do affect us. Foreign exchange markets fluctuations, stock markets in the other areas of the world affect us. So derivatives are are affected by this. Ria Gupta, there is risk in hedging in two ways. If you are using a futures instrument, risk is not there directly, but you can have an opportunity loss. If you are using an options instrument, you are paying a premium. To that extent, the risk is there. Shiv Shankar. Yeah, there are two things, Shiva Shankar. There's something called speculation, something called hedging. Speculation does not have any theory. It is like a gambling. So people can make money in the stock markets through speculation, which we are not even discussing, because that is like a gamble and may not work all the time. But they can use options for many optimization of portfolio, which you will understand after you have understood the derivatives instruments correctly. There are some techniques by which you can, again, no free lunch, you have a very good possibility of making better money using option strategies along with your existing portfolio, provided you understand the instruments very well. So, unfortunately, this is not a forum in which that can be explained. Again, the book gives you so many examples of various ways in which that can be optimized. It is possible. Any other question? I'll be on any view that you have, kindly let me know. Okay, I'll minimize this then. Uh, I'm very glad that you have been using my books. Learn it actually. Derivatives, you cannot make money without much risk. There are no risk free strategies. There are strategies which are there for various purposes. For example, when the markets are dull or when the markets are likely to be slightly bullish, not heavily bullish, or the markets are likely to be steady. So there are some strategies, but it all is based upon your original perspective. And if the perspective is wrong, sometimes it can your there's no free lunch. You can go wrong as well. But with experience, you can develop strategies which are, let us say, 75% right. So 10 times you do, 7 to 8 times you are right, and it can happen that way. That's how this can be done. Dr. Jayashree, I would also say one more thing, that there's no expert who can predict the market, really speaking, because what happens is predictability involves so many things, and markets are so very uncertain. It all depends on so many conditions that one cannot really predict. But in an options market, which is actually closely connected to the stock market, we are looking at the stock market as the underlying and the options market as the derivative. And if you look at it that way, it becomes better. For the questions that I'm seeing are, oh, research areas, Dr. Jayasree, it is very fertile. And India, we have not had many researchers done on derivatives. Everything is possible. You can do a lot of research on futures. You can try also the index with futures. You can also try the stock markets and their movements. There is a concept called cost of carry. When you come to options, you can compare options with futures. Contrary to what many people feel, options are not always superior to futures. So you can find out the circumstances. You can also draw some synthetics. This is another development that derivatives do. And you can combine futures with options. You can combine stocks with futures. You can combine bonds with. So that research, I would say, is very fertile. It is possible. And data is available through NSE and BSE also. So because of that, it is really a fertile area. But it is required that in order for it to be original, and in order for you to come to some sort of conclusions, you will need large data. And working with large data, you will probably require a good software to help you. Hedging is not the same as arbitrage, Rahila. It is hedging is risk management. Arbitrage is buying from a cheap market and selling to a dear market. So I hope I have answered these questions. You could, of course, always be whatever I can do. I can always be of help if you can send me mails or any queries to the extent that I can. Of course, this it's an emerging area, or you could have your own observations from which I can learn. Yeah, it is bringing, Dr. Jayashree is bringing a lot of changes in the artificial intelligence, or fintech is bringing, because what happens is we're going to use technology. When we use technology, we can deal with large numbers. We can also deal with larger data. And when you do that, your prediction becomes better. For example, if you want to know about the trend in the market, and you want to know how the market's behaved over the last 6 months, and then you will have in derivatives, because of several possible options within a particular price range, you will have some limitations of finding out. But with big data analysis, it is possible to find out what actually took place. But I'm not sure about how artificial intelligence can be used. I can only understand that fintech can be used in many ways, but I am not sure how it can actually trade for us in any way different, because I see that stock market trading is as much an art as a science. It is not something that can be prescribed. It's something, not a template, for example. So I can't imagine that really happening, but I don't know. Let me confess to my lack of adequate knowledge about AI to in this field. So that's it actually. But you can always, in case you have any clarifications for the book also has my details and my mail ID. You can get in touch with me, and I'll be very happy to the extent as I can. I would like to do that even on your research interests. But thank you very much for patient hearing, and all the very best. Thank you.